Good afternoon, everybody, and welcome to the H1 MAGNiTT webinar on the state of venture capital across emerging markets. I hope some of you are able to get an e-break back in June, and we're seeing that there's still a lot of activity happening in July. So we'd love to share and take this opportunity to share some of the insights that are happening from the venture capital world across the emerging market space. I'll be doing a presentation for about 20 to 30 minutes. Following that, I'll open the floor up to any questions. So if you have any questions, please do share them in the chat box or in the Q&A, and I'll be sure to try and address them. And I'll dive right into this. So for those that may be familiar for the first time, may not be familiar and the first time to see MAGNiTT, MAGNiTT is the leading private capital data platform covering emerging venture markets, which we coin as Africa, the Middle East, Pakistan, Turkey, and Southeast Asia. Our focus is to make sure that we can capture as much of the private capital data that we can for the emerging market space as a point of reference. From that, we're able to create insights and research for the markets that we're in. One of the things that I've now started to do as part of the tradition is to look at the global macroeconomic environment in H1 2024 before jumping into the VC space. So if we look at some of the macroeconomic indicators and things that are happening, lots of news, and I'm just summarizing some of them that are potentially pertinent to the venture capital space. We've seen and continue to see, even heading into July, record stock markets, sticky interest rates, elections and political sensitivities that are happening across the globe, AI's ability to impact venture and public markets, the global IPO window, and what's happening to startups in terms of shutdowns. So as I kind of mentioned, if you look at the public markets, and this is just July, and in many ways, both the NASDAQ, S&P, and the Dow Jones has just hit record highs as well, they've continued to skyrocket. And I think at this point, trying to relate how the public markets is related to the private markets is somewhat challenging. The public markets driven by sentiment, forward-looking sentiment, investor and financial interest in many of the publicly listed companies is at record highs, and that is very positive for those invested in that space. That has not translated necessarily into the private capital market thus far. I've shown different types of charts. I think it's just interesting at this point to highlight the growth of the US market. We've seen kind of flat US real GDP growth. The forecast for this year is slightly higher than 2023. None of this compares to 2021, which was in a low interest rate environment. But as you can see, and it's one of the indicators as to why the public markets continues to do well, is that this is a steady line that goes upwards. Inflation has been curtailed to the high levels that were seen in 2021 and 2022. They have not hit the level of 2%, which is the Fed's aim in the US, but they are lower than had been anticipated. And as a result, despite the Fed rate being consistent now for almost 12 months since last year, there are calls that with the positive indicators of inflation and growth of the GDP, that there is the potential of rate cuts to come to fruition in H2. Many had anticipated rate cuts starting in Q1 of this year. That wasn't the case. We do anticipate that there may be at least one rate cut to end of year, if not the beginning of 2025. Again, one of those that could be a driver to global venture capital and how that could impact the region. One thing that has been positive, specifically for GCC sovereign entities, is that oil prices have remained high. That is a benefit to entities that are able to deploy capital into the venture space from sovereign funds. The challenge of that, and I've mentioned this on previous webinars, is that there's a double-edged sword. Whenever oil prices are high, that can lead to inflationary pressures and the impact of what happens to a Fed funds rate. We always talk about mega deals, and I have a whole section talking about mega deals, but actually when we look at the IPO market, that's the ultimate liquidity event in the US or international markets. IPOs have continued to be muted compared to years gone by. The left-hand side of the chart talks about the number of IPOs, with global IPO down year on year compared to last year, which was already a low year compared to years gone by, and the actual volumes from them are lower. Now, there are signs that, at least in the US, things are slowly picking up. And as you can see here, a chart provided by Ernst & Young, EMEA is seeing a pickup both in the total number of transactions and volumes, but relatively at a global level. The IPO window has not come to fruition. And despite a lot of talk in the region for IPOs of tech companies, we've yet to see that translate, albeit potentially to happen H2 of this year, if not into next year. One headline grabbing news is the role of AI in the funding landscape, not only in the private space, but in the public space. Many speak to the strength of the S&P driven by the big seven. Those are the big seven technology companies, and AI has been a big driver towards that. According to CB Insights, this particular chart, you see that there's been consecutive quarterly increase growth of venture capital investments in AI as a percentage of overall venture capital investment. So clearly, the role of AI is growing globally. We've tried to do the similar things for the markets that we're in. The reality is that the type of AI companies here in the region are very different to those that exist in mature markets like the US and Europe. And actually, the percentage is far lower as a percentage of overall venture capital. But this is something that we are keen on continuing to track moving forwards. And finally, I think it's important to highlight that despite some of the positivity that we're highlighting in the previous macroeconomic charts, that startups are continuing to struggle in this environment. In the absence of that next round of funding, it is likely that we will continue to see companies having to focus on unit economics, and those that can't achieve that and are unable to raise are likely to shut down. This data comes from Carter, and this is a reflection going back to 2020. This is the database of Carter companies, and Q1 and likely Q2, when they publish this data later, had a record number of startup shutdowns as part of their portfolio. So also something to be aware of, that not everything is rosy, or in fact, not everything is positive. So how does this translate into actual venture capital dollar deployment? So I think it's important to always put into context what's happening globally. If you look at the global landscape, we've mentioned this, 2021 was the peak of all venture investments during that environment of 0% interest rates. Liquidity was high, investment was going into all types of companies, cross asset classes, and cross globe. According to the global mandates, we've seen that 2022 was flat in terms of transactions, but we've seen now 3 almost successive years of declining venture capital deployment. Compared to last year, H1 2024 compared to H1 2023, a 7% decline in funding and a 24% drop in terms of deal flow. And when you look at this on a quarterly basis, while at the end of last year, at the beginning of this year, when I did the webinar, I was highlighting that this was clearly a slowdown in venture, albeit to levels that are very similar to the pre-pandemic levels of 2019 and 2020, it was down compared to the peaks of the liquidity boom of 2021 and 2022. What we're seeing now is, according to this chart, my point specifically to where I've said an inflection point, this is the first time globally you have seen 3 quarters, 2 consecutive quarters of growth of venture capital funding. That is dating back to 2020, the last time that it happened. A little bit of a concern, and it's still a red flag, is that it's almost a straight line decline in the total number of transactions that are taking place. So how does that resonate in terms of deal flow slowing down, but there is a slight pickup in capital deployment in the global landscape, which points to me that we are potentially at the bottoming out, or that inflection point where things begin to pick up. Now, to be clear, I don't anticipate this type of inflection point that we saw in 2020 and 2021, an aggressive continuation. I expect that going into Q3 and Q4, they are steady increases. But again, at least at the global level, if we are to see interest rate cuts, it is likely that private capital investors will go into the markets again, given the reduction in the cost of capital. Just comparing the emerging venture markets that we cover, I mentioned Africa, Pakistan, Turkey, the Middle East, and Southeast Asia. Our benchmark is a 34% drop both in capital deployment and the total number of transactions. Again, when we see that against other geographies, the bottoming out is the fact that both global, at a global level, it's 7% decline, 4% in the US, 11% increase in Europe, interestingly, and 0% in LATAM. So we've mentioned many times how the region tends to lag more mature markets. This is still an indicator that we are somewhat lagging in that investor behavior, but we can anticipate that if the global landscape is bottoming out, that we are likely to see this taking place in Q3 and Q4. Q3 traditionally in the region, a slow quarter with a pickup in Q4. So how did the emerging venture markets fare? As you can see here, the point that I was saying, comparing it to global, actual capital funding was flat in 2022 when it was declining globally, a pickup of deals in 2022 compared to 2021, but that decline in deal flow activity and capital began to kick in the middle of 2022, that 2-quarter delay compared to the global data sets. And we are seeing that we're still in the downward trend towards that bottoming out in the emerging venture markets. In fact, you can see here that volatility of that pickup and then drop again. We are trying to work out internally at MAGNiTT, are we going to see a pickup of activity in Q3, where MENA has tended to lag, whereas other geographies have seen better in Southeast Asia, to see that pickup and inflection point reflect in the emerging venture market space. But similarly, that 9-quarter decline globally, we've seen a 7-quarter almost decline, albeit a little bit more bumpy than what we've seen at a global level. So putting all of that into context, in terms of comparisons, we can see that bottoming out effectively a 1% decline flat for the US, Europe, and LATAM in terms of funding, albeit against a 23, 24, 52% decline in deal flow. But here in the region, it's a 41% average decline in funding, while deal flow is somewhat similar to what's happening at a global level. One thing that is important to highlight is that this is very much driven by mega deal investments. What are mega deals? Mega deals are investments that are greater than $100 million of value. Why is that important? And we've had a lot of conversation around the impact of interest rates and the appetite of investors to be able to deploy. The area that we have seen and globally has seen a drop-off that is far more acute in terms of capital deployment is at late stage. We're talking about Series B, C, D, E. That is the mega deal investment rounds, investments greater than $100 million of capital. That pickup that I highlighted of 3 consecutive quarters of growth coincided with that pickup of investment activity, both in terms of deal flow and capital deployment into mega deals. Looking at where we are here in the emerging market, while we did see some pickup of activity in Q3 and Q4, noting that in Q4, 3 mega deals took place in Saudi Arabia alone. That decline going into Q1 and Q2. So interestingly, the UAE has seen no mega deal investment dating back to 18 months. So the question is, will we see that deal flow activity and capital deployment in Q3 and Q4 of late stage? And hence, when I was alluding to the IPO window that exists globally, that is a reflection of that next step beyond mega deals. We don't necessarily have that here in the region. When that starts picking up, that liquidity event also creates a return of investment to investors. And it was also interesting that we were able to pull out a chart from CB Insights and look for a comparison. The role of mega deals in the last 2-3 quarters has accounted for about 45 to 47%. In the peak liquidity events, mega deals contributed close to 60%. If you just take the average for a crude figure of 2021, 60% of all investments came from mega deal investments at a global level. When you look at the markets that we are covering, that level, while during the period of peak liquidity was around 55%, has dropped off now to about 30% of all capital. So actually, there has been a real slowdown of activity at late stage versus early stage. So what are some of the key takeaways as we dive into the regions that we're focused on? The trends that we're seeing at a quarterly level, non-mega deal funding versus early stage funding, Singapore's role across the emerging venture market space, industry breakdowns, how investors are participating, and what do we see as the activity in M&A. So the first thing to kind of note is that quarterly evolution for MENA. As I mentioned, last year and this year, both Eid and the Ramadan periods took place in Q2. That saw a decline of what was strong Q1s in each of the last 2 years, both in terms of deal flow and in terms of capital deployment. Last year, Q3 was lower than every quarter that we've seen previously in the year. And what we're trying to work out in terms of Q3 of this year, a strong indicator as to whether we're seeing an inflection point will be, can we weather the slow summer and then go into what is traditionally the highest quarter of the year, Q4. As you can see here, just looking specifically at Q2's performance, given I did a webinar back in Q1, all of these indicators at a global level are positive. Whereas here, when we're saying that there's still that slowdown or reflection that takes place, while Southeast Asia may be ahead of MENA and Africa, with MENA being almost flat and Africa down, this is a perfect chart to highlight the delayed impact of venture relative to other markets. And so if we believe that this trend is likely to then portray itself going into Q3 and Q4, it shows that that inflection point or bottoming out is likely to come to fruition. Where are investors investing? One thing has been very clear in the report. If we take Saudi Arabia alone, when you strip out the mega deals, there was an 83% increase year on year in non-mega deal investments. That means people that are investing in the venture space are focusing on early stage investment opportunities. In this chart, each of which is an H1 compared to 23 comparison for emerging venture markets, MENA, Africa, and Southeast Asia. We have a breakdown, not by stage, because what we often see is that there is a mix between seed, Series A, what people are doing in different types of geographies. We've capped them by the investment round size, 0 to 1 million, which is effectively a pre-seed investment round, 1 to 5 million, the average for what a seed or pre-seed investment round is, 5 million to 20, which is around a Series A, and then a later stage investment for 20 million. So they're indicators for that. In each of the geographies that we are tracking, except for Southeast Asia, where it's a bit flat, the area that we saw growth was in the 1 to 5 million. So naturally, that is the seed investment round. Investors are finding opportunities where valuations have come down relative to years gone by. In fact, they are pretty much consistent across each of the geographies in line with pre-pandemic levels, which means that they've normalized, are attractive for investors that do have dry powder to deploy. The other benefit that they have is if they have strong product market fit teams, naturally having gone through the evolution of a lower venture environment that we've seen in the last 2 years, people have to be frugal and unit economic focused. So if you're making a bet at that stage, you know that the founders are going to have to make their money work. The exit window, as we know from the data at MAGNiTT, tends to be between 7 to 8 years. Therefore, if you are investing, which is why many people say it's the best time to invest during an economic downturn, in founders that have strong product market fit and strong teams in this environment, they are likely to make their money work better than companies that were raising 3 to 4 years gone by at valuations that are more attractive, and then weather the storm to come out of it when venture picks up again and we start seeing exits happen for a better return of investment for investors. So naturally, investors are focused on that versus late stage where they're still trying to work out when that company is either having to experience a down round, potentially not willing to accept lower valuations, or when they believe that they're going to get their next investment. It's also interesting to see across all of the markets that we're covering. So if you saw the Bloomberg article that was published only recently, it said that Saudi Arabia trails only Singapore, the first time that there's been a publication talking about emerging venture markets, specifically highlighting Saudi's growth in the wider ecosystem. But at the same time, I've been reading a lot of literature on Southeast Asia. There have been clear reasons for a slowdown of venture capital investment in Southeast Asia. Singapore, the hub of venture investments, remains the leader, even when compared to the rest of the emerging venture market space, albeit a 30% drop in capital deployment, is 3 times bigger than Saudi, which ranks first in the rest of MENA. Now, interestingly, in the Saudi case, it's an almost flat return year on year, which is extremely positive. And the most important point that I already alluded to was an 83% growth in non-mega deal fundings. What do I mean by that? There was one mega deal in Saudi Arabia, the only mega deal that took place in the MENA region in the first 6 months, for 130 million for Salah. If you strip that figure out, it'll fall more or less in line with the fourth or fifth place in the rankings table. But what was last year was two mega deals that accounted for close to 70% of all of the capital deployment. So that means that the funnel growth at the bottom of the pyramid is extremely healthy for future investment opportunities within the kingdom. You then see Thailand and Indonesia, and then the UAE and Turkey. In terms of the total number of transactions, so the idea that investors are willing to put their bets in terms of investments, specifically at early stage, Singapore, again, reflects as the ecosystem that's seen the most number of transactions, albeit, again, relative to the total amount of funding, a 30% decline or a 27% decline in total number of transactions. Turkey, a ripe environment for early stage investment, sees an almost 50% decline, but still ranks second. And the UAE, as you can see in this top 10 ranking, the only geography to see a year-on-year increase in the number of transactions, up 11%, ranks third, followed by Saudi Arabia and Indonesia. So it really is an opportunity to benchmark all of these three different ecosystems. And we've tried in previous webinars to highlight that if the MENA region is about 10 years in its fruition, Southeast Asia maybe 15, Africa maybe 6 to 7, the impact of that history in the geographies in the rankings before we start comparing it to global markets like the US, China, India, or even European geographies. There's enough to benchmark in geographies that see similar challenges and opportunities within them. In terms of the sectorial shift, people keep asking me, is there a change? So at an EVM level, fintech remains the industry of choice, both by the total number of transactions and the capital deployment. This is also a reflection of what's happening globally. It is one of the areas that is still ripe for disruption, even in this slightly slower venture environment. You then see the traditional infrastructure plays of e-commerce, transport, logistics, across each of the geographies. Specifically in MENA, the same thing can be said. Fintech ranks first in the total number of transactions, whereas e-commerce actually comes first in terms of funding. But as I've mentioned, there is one investment in Salah for 130 million that accounts for almost half of that investment. Strip that away, fintech actually ranks first compared to many of the other geographies. I was recently asked just yesterday on an interview, what is the role of international investors in deploying capital into the markets that we're covering? Well, year on year, they're effectively still account for emerging venture markets. 60% of all of the investments, 60% of all of the institutions that are making investments in emerging venture markets. The total number has seen a slower pace compared to last year at an aggregate level. But for those interested in the MENA region, we actually saw a 32% increase in the number of institutions investing in MENA-based companies, albeit the same level of international participants. And I do believe, having recorded from MAGNiTT a 130% increase in the total number of fund announcements in the first 6 months of this year compared to last year, that many of the government initiatives, specifically in the UAE, Saudi, and Qatar, that made their announcement of the $100 billion fund of funds to attract international investors and investors to deploy capital into the region, is beginning to see signs of fruition, albeit we expect by the time that they set up and start deploying capital, that may actually start reflecting in Q3, if not Q4 of this year, with very positive signs heading into 2025. Interestingly, though, when it looks at the capital deployed and the breakdown of what comes from MENA versus international, historically, when we go back to the liquid boom era of 2021 and 2022, it was very common to be hearing that Sequoia was coming to the region, SoftBank, Coatue, Tiger Global. Those type of institutions have pulled back, focusing on their home markets. An article that I was just reading about Southeast Asia, one of the challenges that they're facing are these cross-asset class investors have pulled back and focused on their core functions as opposed to venture capital. that has translated into the actual capital deployment from international players. So on this chart where we say where they're coming from, here the actual dollar amount has receded about 50% to only 25% of all capital deployment, highlighting that those that are participating are likely to be early stage investors, whether accelerators or seed funds, as opposed to late stage investors for the region. Here is just a very high level perception of some of the investors that are active across the MENA space, 500, Antler. As you can tell, names that are synonymous for early stage seed Series A investments. And at the late stage, where we can see capital deployment, traditional names like Sanabel, Investcorp, STV, wide in both that plays across the different gamuts of investment opportunities. And the final thing, and this is something that we continue to try and get our heads around, is what exit activity is happening. So we had continued to believe that there would be a flurry of exit activity. I do still think that that is waiting, and that is likely to happen in the coming quarters, if not in 2025. The data has highlighted, though, that this has slowed down significantly compared to previous years at an emerging venture market level. Even when we specifically look at the MENA exit activity, it has remained muted. We hear of conversations of IPOs happening in Saudi Arabia and potentially in the UAE, although they've yet to come to fruition. We have seen several announcements of pre-IPO investments, including Salah, Tabi, Tamara, and the likes, but we haven't heard of the actual listings. And I'm sure that a lot of that has to do with the operational challenges of actually listing on an exchange, but that doesn't mean that it isn't going to happen at some point. But I do go back to the macroeconomic data that I highlighted, that at a global level, the IPOs haven't necessarily been active in that space. So before I come into the questions, and if you have any questions, please do share them and I'll try my hardest to be able to answer them. How can MAGNiTT help you? Well, effectively, we focus on private capital. We started with venture capital. We will be putting private equity data onto the platform. We already have venture debt data while we look at how to bring on private credit onto the platform, covering the emerging venture market space with over 35,000 or 34,000 companies and 20,000 transactions on the platform. Just a couple of the areas that we've continued to add to the platform, we've included custom directories where you can create on-demand presentations and cuts of the data for you and your team. Lead investors, that means that we have more accurate representation of the capital deployment, and saved searches that allow you to continue to come back and check whether there's been investment updates based on your mandates. And here are some of the features that you can get access to, and please feel free to reach out to the team, and I'll ask one of our team members to share the enterprise page and the sales email for you to be able to get access. And if you're interested in downloading the report, please feel free to go to our website or use your QR code here to be able to download it. So I'll quickly go into any questions that people may have. So feel free to put them in both the QA box. Is there any reason behind the focus on early stage investments? Mohammed asks. I think I addressed that, but effectively the slowdown at late stage can largely be driven by, one, the down round phenomena, that people are reluctant to have to do down rounds compared to the years gone by and are focusing on unit economics. So there's a lot of bridge round activity. Also, the cost of capital is actually higher, so investors have to work out whether the return is justified. And finally, we just go back to the points as to why early stage is attractive. One, valuations are more attractive than they have been in the last 2 to 3 years, returning to pre-pandemic levels. If you do have dry powder, your view is to give a 7-year horizon for exits, and therefore, as a result, investing now will coincide with a pickup of venture capital investment activity in 5 to 6 years. And people have definitely focused on unit economics now. So if you have a good product market fit team and scaling into the right markets in MENA, there is dry powder available. We've seen 30% increase in the total number of funds announcements. So there is capital to deploy. It's just you have to be attractive for the right type of investors. I'm just going to stop the share for now to be able to see. Will fintech get beaten by another vertical in the next 5 years? Syed, look, I was asked this by a government entity yesterday as to what is the evolution that we can learn from other geographies. The first evolution of industries that get disrupted tend to be e-commerce in the first point of call as an infrastructure play, then transport and logistics. So if you think about e-commerce as moving products and goods, transport and logistics is moving humans, or trucking and that type of activity. The third is financial services, where you're moving money. The fourth, and I think if you look at Singapore, that has already had success, at least in terms of many successfully funded companies in e-commerce, logistics, and fintech, the focus becomes deep tech. Now, the challenge with deep tech, and we're talking about sustainability, we're talking about food tech, we're talking about blockchain, AI, the development of things that are outside the realm of infrastructure, they tend to require deep investment in tech and coding. They require patient capital for research and development, and they require government initiatives to support at the early stage. So I think that's the next evolution. For that to take place, we are likely to have to see liquidity events for investors to have a bigger risk appetite to invest in that type of vertical. And one of the challenges that people kind of need to appreciate that unless we see more exit and return of investment to investors, they remain risk averse and are likely to invest in entities that have a clear path to exit. And that exit can only come from an IPO. And we've already seen the challenges with regards to IPOs here in the region in terms of the numbers and the ability to list, or acquisition, which means there needs to be a clear competitor globally that may be interested in that proposition. So in the absence of that, people tend to focus specifically on areas that they're comfortable with a clear path to exit. Has the current political and security circumstances affected deal flow in the Levant? Look, clearly it can't be to the benefit of the Levant. I think that the challenges are, when you look at it at the wider level, whether it's Jordan and Lebanon and even Iraq, if that's considered as a Levant, part of the challenges there is the access to capital and the ability to be able to deploy that locally. They've hardly been helped by that environment. They historically used to be at the forefront of much of the investment activity. What has begun to happen, and I see that here in the UAE and in Saudi Arabia, many entities have kept their back offices in those geographies, but have to move location in terms of headquarters and management team for sales into Saudi Arabia and the UAE to be able to raise capital so that they can arbitrage the opportunity of keeping their tech talent back in the Levant while operating in markets like Saudi and UAE, where there is capital availability from some of the sovereign entities that have deployed into local VC. What is the percentage of safe notes versus price notes for deals in MENA during the past year? Great question, Dina. I do not have that offhand. I know that we track convertible notes versus price rounds on the platform. I don't know that we specifically have whether they're safe notes, but that is a good question that I don't have an answer to. I know that Carter puts out a lot of data around this. Now, obviously, they're a cap management platform, so they'll be able to actually track that because that's the purpose of the platform. But that's not something that we focus on specifically. Do you think there's a delay in Series A funding is due to a lot of safe notes converting now and probably diluting a lot of the stakeholders? Good question. I'm not sure that that's what the delay is necessarily. I think that the availability of capital, the willingness of companies to accept down rounds, and the challenges of the conversion of those safe notes are questions that may be posed. But effectively, I think that as valuations came down, or at least are flat in terms of seed, we've definitely seen them come down in Series A. And that one thing that has definitely changed, take a step back, go back 5-6 years ago, people tended to raise for every 12 months for the next capital raise. So you would raise, burn, raise, burn. The slowdown has basically meant that there is no guarantee, although there was never a guarantee, there is a lower availability of capital to raise again. And therefore, in the absence of being able to raise again, people have slowed down their raising activity and focused on weathering the storm. Once we start weathering the storm, capital and risk appetite grows and people look to deploy back into venture, that activity will pick up again. And I think that when it comes down to valuations relative to what was raised in years gone by, that becomes a motive conversation for investors, founders, and previous investors who have supported those companies. And I think that has been a bigger challenge for Series A and Series B companies than possibly the dilution impact. Yeah, there's also questions in the chat. Please, can you explain the trends in IPO exits in the region since 2023? Well, off the top of my head, in terms of tech IPO exits, there have not been any in 2023 onwards. There has been a lot of conversation in Saudi Arabia and the UAE with many of the unicorn startups that are focused on potential listings. I know that the regulators, both in Saudi and the UAE, are looking to see how to support the listing of many of those companies. But to date, albeit that we have heard of pre-IPO investment being made at later stages for those companies, we have yet to actually see those listings in the market. I can be corrected, and even if it's not zero, it's one or two, but we have not seen many IPO listings from tech companies. What are the most active investors in healthcare? Bilal, I don't have that offhand. If you're a client of the MAGNiTT platform, or you would like to reach out to a member of the team, they will be accurately able to tell you who are the investors that have invested in health tech companies, both by capital deployed and the total number of transactions, as one of the tools that we have on our analytics features on the platform. What are your optics on climate tech, as this vertical has been seen growing in Africa, but less in other emerging markets? Look, we've done a recent report on climate tech. We did a climate tech report at the end of last year in collaboration with Crescent Ventures. There is a lot of government focus, especially around COP28 and then the further COPs that are taking place. The challenge here is what I kind of alluded to. To have risk appetite into that space, you need to see where the exit is going to come from, or a greater risk appetite having already seen liquidity from investments that you have done historically. In the absence of both the return of that investment and your ability to actually see clear paths of exit, in which climate tech, you are looking for big players, whether they're corporates, government, and or international players, which is a lot more limited than potentially e-commerce, logistics, or finance. You are going to see it struggle in terms of capital deployment. Not to say there aren't great companies that are requiring investment for growth, but many of them may require research, grant, or government subsidies to get to a point where they become interesting for venture. And that's one of the challenges that we're seeing, albeit this week, I think Sharoop made an investment in an Omani climate tech company, and we're beginning to see interest. That's the deep tech portion of what I mentioned is the next evolution after fintech that can become interesting for the region. What do you think is important for investors coming into KSA for the first time to know? Great question. They need to understand the market. They need to understand the differences of Saudi Arabia, the UAE, MENA compared to international markets. They need to understand the relationship-based approach to raising investment. They need to understand who the key players are in the kingdom, both at a government level, a sovereign level, that it takes time to build relationships in Saudi Arabia. It is not a fly-in model and leave. Most importantly, if you're looking to invest in the kingdom, then you need to put boots on the ground so that you have presence there. You need to build relationships with the key stakeholders. That is not a fly-in, fly-out model. And they are very hungry in Saudi Arabia for intellectual capital transfer, wisdom, knowledge, expertise. What happens globally? How can you bring it to the kingdom? And so to be able to crack that, you need to spend time in the kingdom as you would do in any other market. But what we have definitely seen is people just coming in, having a meeting and expecting to raise funds for a fund internationally is one that hasn't necessarily been successful to date. What's your opinion on funding in the manufacturing industry? Is it growing because others are falling, or is it a new trend? I mean, I don't think it's necessarily growing. Manufacturing, or at least unless it's tech manufacturing or it's a tech solution, venture tends to focus on scalable products or scalable solutions where they can create efficiencies where inefficiencies exist using technology. The challenge with manufacturing, or at least some of the companies that do see manufacturing, are usually one or two deals that are specific to that sector. They may influence that investment activity. But I don't think that it's necessarily a new trend. It may be specific to companies that are solving for particular solutions. Thanks for pointing out slide 33. I'll check that. Yeah, so manufacturing is in the capital deployment of 398, but it's funding. So my assumption, without knowing the specific deal, is that it is one or two large deals that are accounting for that, as opposed to it being the. So I always say that when you look at the total number of transactions, the total amount of funding, total number of transactions tells you the actual appetite that people have for a particular sector, because multiple people are making multiple transactions. When you look at capital deployment, without knowing the total number of transactions, it's the bet you're ready to make on a company within a particular sector. So it may be one or two great companies in that sector, as opposed to it being a trend, shall we call it, of investment activity moving towards a particular sector over another. Any plans to do reports on micro private equity space in the MENA region? Absolutely. So I mentioned earlier, we had already published earlier this year the first Saudi private equity report in sponsorship with SVC. We are in the process of gathering all private equity data across emerging venture markets, ranging from Africa to Southeast Asia. We will be looking to create multiple reports at year end, starting with an annual report and then a breakdown by geography into private equity for the markets that we're covering to complement the venture capital research. And that data should be available on the platform by end of year, if not earlier, for anyone that's interested. So if you're looking at private capital in terms of venture capital, private equity, venture debt, MAGNiTT will have that data and research intelligence on the platform in the coming months. Any other questions? If there are no more questions, it leaves me to thank you. Please reach out to the team if you would like to get any more information or access to the MAGNiTT platform. We do welcome any of your feedback on these sessions. Love to hear what kind of research you'd be interested in getting access to that we can focus on. We are positive about the next 6 months, specifically compared to the last 12 to 18 months that we have seen. There are indicators that we will continue to see at least moderate growth in venture capital and continued focus in some geographies by governments in this space. We plan to host several new webinars and conversations in the coming months. So please stay tuned, sign up to our newsletter if you want to stay up to date, and we look forward to hosting you on future webinars. Thank you very much.